The 2025 housing crash is no longer a prediction. It is here. Some cities are already buried with foreclosure numbers that feel like the worst days of 2008 all over again. But this is not just a story about prices coming down. It is about watching entire local economies start to unravel in real time. And the unsettling part is how many people still believe this is just a temporary dip that'll bounce right back. Today on Discover the Nation, we are traveling through 10 cities where home values are not slipping gently. They are plunging, in some cases by half or more. We're going to show you where the bubble finally burst, where homeowners are now stuck, and why for many families, the American dream has been quietly repossessed. Stay with us. Make sure you are subscribed to Discover the Nation and tap that like button, because what you are about to see could keep you from making a very expensive mistake. Now let us begin our countdown.
Number 10, Cape Coral, Florida. You pull into Cape Coral and at first it looks like the Florida brochure come to life. Canals everywhere, sunshine, waterfront homes, and no state income tax. It feels like the perfect setup. Then you open the housing data. In less than 2 years, the median home price has fallen from around $465,000 to roughly $260,000. That is a drop of more than 40%, and the slide has not stopped. The real shock arrives when you look at insurance. Homeowners here are not just facing higher premiums, many are being dropped altogether. Florida's insurance system is under severe strain, and families in Cape Coral are paying a price. It is now common to see annual homeowners insurance quotes of $8,000 to $10,000 on properties worth around $300,000. One local couple watched their premium double while the appraised value of their house fell by more than $100,000 below what they paid. That dream of affordable coastal living has turned into a fixed cost that keeps rising as the value of the asset sinks. Hurricane Ian tore through Lee County and left lasting scars. Rebuilding costs soared. Some contractors never finished jobs. Government assistance moved slowly. At the same time, homeowners associations still expect dues, and special assessments often arrive when families are already stretched. Houses sit on the market for half a year or more. Price cuts are not small adjustments. They are deep, desperate reductions meant to attract any serious buyer. One waterfront property that started near $899,000 ended up selling in the low $400,000s after months of sitting. Even the rental market offers little comfort. Rents have started to soften but remain high enough to squeeze household budgets. Cape Coral has become the place where the cost of insurance, repairs, and uncertainty weighs against every decision. If you live here or have considered buying here, share your experience in the comments. The numbers coming out of this part of Florida are a warning for every coastal market in the country.
Number 9. Austin, Texas. You arrive in Austin expecting booming tech campuses, music venues, and endless growth stories. For a while, that story looked untouchable. Home prices surged more than 90% during the pandemic run-up as companies expanded and remote workers flooded in. Then the cycle turned. By mid-2025, the median home price had fallen from around $575,000 to just under $385,000, roughly a one-third decline, with more weakness still in the pipeline. The drivers are easy to see. Large employers trimmed staff. Prominent tech firms slowed hiring or announced layoffs. The high-rise rental towers that once symbolized new prosperity now carry high vacancy rates and aggressive concessions. Owners who bought brand-new condos at peak pricing are discovering that resale demand is not there at the prices they expected. Mortgage rates above 7% have cooled enthusiasm for expensive urban living. It is increasingly difficult to convince buyers to pay close to $1 million for small lots, limited yards, and modern finishes that already feel dated. Days on market tell the story. Listings that would have attracted multiple offers in a weekend now sit for 4 to 6 months. A new build in East Austin that originally came to market near $799,000 is now advertised closer to $499,000, and it is still waiting for the right buyer. Homeowners associations remain active and costly, even when amenities are underused. Some buildings have tried to add technology fees or specialty charges to keep budgets afloat while units sit empty. Extreme heat, Recurring power grid concerns and rising insurance costs are adding another layer of risk. Utility rates have climbed. Water constraints and infrastructure stress have become part of the local conversation. The migration pattern that once brought steady inflows of people has slowed and in some cases reversed. Some residents who moved in during the hype are quietly relocating again to less expensive regions. If you or someone you know bought in Austin during the peak, let us know how the numbers look now. The city once held up as the next great tech capital is discovering what happens when growth expectations outrun economic reality.
Number 8. Boise, Idaho. Boise used to be the quiet success story of the Mountain West, a place where people went to find space, scenery, and reasonable prices. Then the national spotlight hit. Between 2020 and 2022, home values soared more than 70% as buyers from high-cost coastal states rushed in. By mid-2025, that surge had reversed violently. Prices have fallen close to half from their peak, with the median value dropping from the mid-500,000s toward the high 200,000s in many areas. The core issue is that too many buyers paid far above underlying local incomes. Remote workers brought big city paychecks, but many jobs were never truly rooted in the local economy. When tech companies began to pull back and remote work policies tightened, some of those higher earners left. Boise was left with home prices that reflected temporary demand, but wages more in line with its historic profile. New subdivisions filled the edges of town with rows of modern homes built for rapid growth that has now slowed. Some properties have already passed through foreclosure. Others are being sold at steep losses. Reports circulate of individual owners losing six figures in equity on speculative purchases that were meant to be quick flips. Rental markets offer little relief. Rents have begun to decline as vacancies rise, but not enough to compensate investors who still face higher interest costs and rising expenses. Wildfire risk and changing climate patterns are also starting to influence insurance pricing. Premiums in certain zones have steadily moved higher, adding another fixed cost to already strained budgets. Meanwhile, local debate has intensified. Longtime residents, frustrated by the rapid changes of the boom years, now watch as some of that construction sits underused. If you moved to Boise seeking a safe haven and found something very different, tell us your story in the comments. This city shows how quickly a so-called hidden gem can become an example of what happens when investment arrives faster than sustainable job growth.
Number 7. Las Vegas, Nevada. Las Vegas has always embraced risk, but the latest gamble was not on the casino floor. It was in the neighborhoods that ring the valley. During the recent boom, median home prices climbed toward $475,000 as investors, second home buyers, and new residents competed for limited supply. By 2025, that median has fallen to the high 200,000s, a drop of around 60% in some segments, and many analysts believe the market has not yet found a true floor. In the post-pandemic surge, short-term rental properties multiplied. Investors bought single-family homes and condominiums, expecting steady tourism and nightly rental income. When travel patterns shifted, competition increased, and visitors became more cost-conscious, many of those units lost their edge. Occupancy softened. Some owners discovered that their projected returns no longer covered their mortgages, taxes, and maintenance. At the same time, the broader economic backdrop has become more complicated. Water scarcity concerns and record heat have drawn national attention. Insurance costs have risen as environmental risks become harder to ignore. Utility bills in the hottest months strain household budgets. In newer subdivisions on the outskirts, partially completed projects in quiet streets hint at plans that no longer match current demand. Workers in hospitality and entertainment, the backbone of the local economy, face their own challenges. Wages in many service jobs have not kept pace with recent housing costs, even after corrections. Some households that bought late in the cycle now find themselves with negative equity, meaning they owe more on their mortgage than the home would likely sell for today. Las Vegas built its reputation on reinvention, but the current housing reset is forcing a different kind of calculation. If you have considered buying or investing here, ask yourself whether the potential reward truly matches the layers of risk. Share your thoughts below if you have lived through a real estate swing in this city that never sleeps.
Number 6. Phoenix, Arizona. In Phoenix, the heat is not just in the air, it is in the housing data. During the peak of the recent cycle, the median home price in the metro climbed into the low $600,000 range as demand flooded in from higher-cost states. Since then, values have fallen sharply, with many estimates putting the decline near 50% from that extreme high, bringing typical prices back toward the low 300,000s. For homeowners who bought in those top years, that drop is not just a number on a chart. It is the difference between positive equity and being stuck. The characteristics of the boom are now clear. Investors bought aggressively. Remote workers arrived with expectations of permanent flexibility. Builders launched large subdivisions across the valley. New rooftops went up faster than schools, clinics, and shops could follow. When interest rates rose and the cost of borrowing reset, the pace of purchasing slowed dramatically. Many listings now remain active for 5 months or longer. Sellers are increasingly forced to accept offers well below last year's asking prices, often including closing cost credits, rate buy-downs, or extra concessions on appliances and upgrades just to get a contract signed. The environmental backdrop adds to the pressure. Phoenix regularly experiences triple-digit temperatures for long stretches, driving higher utility usage and costs. Power companies have adjusted rates upward, citing increased demand and infrastructure strain. At the same time, long-term water supply from the Colorado River has come under scrutiny, with certain new developments facing tighter restrictions and more intense review before permits are issued. Insurance companies are also recalibrating their appetite for risk in hotter, drier regions. Policies can be more expensive, and some coverage comes with higher deductibles, new exclusions, or limits on claims related to extreme heat and storms. For households squeezing their budgets to stay current on their mortgages, those added line items matter. Investors who once penciled in optimistic cash flow projections are now revising their spreadsheets and finding gaps. Phoenix was marketed as an affordable alternative to coastal markets, with sunshine and space as its selling points. Now, many recent buyers are discovering that affordability depends on stable utility costs, manageable insurance, realistic home prices, and steady employment, not just the initial purchase price. Some families who plan to move here for opportunity are pausing and rethinking their plans. If this is a market you are watching, let us know in the comments whether the current correction has changed how you see the valley.
Number 5. San Francisco, California. San Francisco was once the symbol of unstoppable tech wealth. For years, the idea that home prices here could truly fall in a meaningful way seemed almost unthinkable. But in the last few years, that belief has been tested. From a peak median price near $1.6 million, values have slid to under $900,000 in many parts of the metro, a correction of more than 50% in some segments. Even after that drop, the city remains expensive, but the direction of movement has changed, and the psychology of buyers and sellers has shifted. The drivers are complex. A prolonged shift toward remote work left many downtown offices underused. Some companies downsized or relocated. Commercial vacancies climbed. Surrounding residential buildings felt the impact as downtown amenities thinned out and daily foot traffic shrank. Buyers who once paid a premium for proximity to major headquarters now question whether those addresses hold the same value when teams are dispersed and hybrid schedules are common. Neighborhoods that depended on office crowds for restaurants and shops have had to adapt or close. Residents who stretch to buy small homes or condominiums at peak prices are feeling the weight of property taxes, association dues, and insurance costs that did not fall as quickly as market values. In some buildings, monthly HOA fees can run into 4-figure territory, while essential upgrades still wait to be completed, from seismic retrofits to plumbing and elevator modernization. That creates a difficult equation. Owners may not want to sell at a loss, but holding on requires ongoing investment. Wildfire risk in nearby regions has also shaped the insurance landscape. Some providers have tightened their criteria or withdrawn from certain areas, leaving households searching for new coverage at higher cost or with reduced options. At the same time, broader concerns about public safety, retail closures, and visible homelessness have entered many buyers' calculations. The combination of elevated ongoing expenses, changing work patterns, and softened demand has pushed more owners to consider selling, even if that means accepting a notable loss compared with what they once expected. San Francisco's story is no longer just about explosive growth and extraordinary returns. It is about what happens when tech equity and real estate speculation intersect with real-world limits, infrastructure strain, and affordability pressures on the local workforce. It raises questions about who can remain in the city and what kind of economy it can sustain. If you have watched this market from inside or from afar, share how your perception has changed over the last few years and whether you see this as a temporary reset or a long-term realignment.
Number 4. Myrtle Beach, South Carolina. Myrtle Beach looks at first glance like the classic coastal playground. Wide beaches, resort towers, golf carts, and an endless flow of visitors. During the pandemic era, it became an investment magnet. Buyers from around the country snapped up beachfront condominiums and short-term rentals, confident that tourism revenue would always cover the bills. Since 2023, that confidence has been tested hard. Home values have dropped more than 45% in many segments, turning a surge into a steep slide and leaving many owners with far less equity than they planned. The recipe for trouble is familiar. Too many investors chasing the same strategy, too many similar properties coming online at once, and a growing list of expenses. Some homeowners association fees now run hundreds of dollars per month, even in buildings with maintenance backlogs and aging infrastructure. Owners report significant equity losses while still writing large checks for dues, assessments, and repairs. Cash flow that once looked comfortably positive on paper is now much closer to break even. Insurance has shifted as well. Rising concern about hurricanes and flooding has driven premiums higher and in some cases led carriers to reduce or cancel coverage after relatively modest events. For an investor relying on slim margins or a retiree on a fixed income, a sudden jump in cost can turn a property from asset to liability almost overnight. New developments continue to move forward in some coastal zones, even as existing units struggle to stay occupied. That imbalance feeds oversupply, pushing prices down while costs remain stubbornly high. Locals have seen traffic rise and infrastructure strain without always sharing in the gains of the boom years. Service workers who support the tourism economy often live farther inland, commuting into an area where many balconies stay dark in the off-season. If your vision of a beach town investment included stable income and long-term appreciation, Myrtle Beach is a reminder that coastal real estate carries risks beyond the postcard images. Tell us in the comments if you have watched this market transform from opportunity into challenge, and whether you think it can rebalance.
Number 3. Salt Lake City, Utah. Salt Lake City drew national attention as an affordable alternative to West Coast metros. For a time, it looked like the perfect compromise. Beautiful scenery, an emerging tech sector, and lower prices than California. Between 2020 and 2022, home values surged roughly 75%. Since then, they have fallen more than 40% from that peak, pulling the median price from around $620,000 to the mid-300s in many areas, and leaving recent buyers reevaluating their plans. At the height of the boom, remote workers and new arrivals from more expensive states bid aggressively, often paying above asking for even modest properties. Builders responded by pushing new projects forward in suburbs and foothill communities, confident that demand would remain strong. As interest rates rose and corporate hiring slowed, the tone changed. Listings that once received multiple offers now remain on the market for weeks and months. Sellers increasingly add phrases like motivated and open to concessions as they adjust expectations and consider price cuts they would have rejected a year earlier. Downtown and near-campus rental markets have also softened. Property managers offer free months of rent, gift cards, reduced deposits, and other incentives to attract tenants. For landlords who bought during the surge with the expectation of constant demand and steady rent increases, those incentives cut directly into returns. Some small investors are quietly looking for an exit, even if that means absorbing a short-term loss. Environmental and structural risks add another layer. Wildfire concerns in the foothills have grown as summers become hotter and drier. Earthquake risk, once rarely discussed outside of technical circles, has become a more frequent part of insurance and planning conversations. Community associations in suburban neighborhoods have also become stricter, enforcing rules that can add fees and strain relationships over parking, landscaping, or rental limits. Salt Lake City's turn from hidden value to overvalued and then to correction has been fast. It has forced residents and planners to think about how much growth the region can absorb and what kind of infrastructure and housing mix it really needs. If you have lived in this region or considered moving there, let us know how the latest housing trends have shaped your decision and whether you see this as an opportunity or a warning sign.
Number 2, Naples, Florida. Naples has long represented a certain version of Florida luxury. Carefully manicured neighborhoods, golf communities, and waterfront properties drew retirees and second homeowners from across the country. At the peak of the recent cycle, average home prices in some parts of Naples reached around $1.1 million. Since then, values have fallen sharply. Many homes now sell for close to half of their previous numbers, and certain high-end condominiums have seen even steeper declines, challenging the assumption that prime coastal property only moves upward. Severe storms exposed just how fragile the model was. Hurricane Ian and other major weather events caused extensive damage, driving up the cost of rebuilding and drawing renewed attention to flood and wind risk. Insurance premiums in Collier County have climbed dramatically since 2023, in some cases tripling in only a few renewal cycles. For many owners, policies that once cost a few $1,000s per year now run into 5 figures, putting pressure on retirement budgets and investment plans. Citizens Property Insurance, the state-backed insurer of last resort, has experienced surging demand, with some applicants facing delays or stricter conditions. That means more households are carrying expensive coverage or accepting less than ideal protection while still paying association dues and property taxes based on values that no longer exist on the open market. For buyers who came in during the peak years, that combination can feel like a financial squeeze from both sides. Naples is also dense with gated communities and strict homeowners associations. Monthly fees can be substantial, and special assessments for repairs or improvements add to the burden. Projects like seawall reinforcement, roof replacement, and clubhouse renovations often translate into large one-time charges. For people who bought at peak prices, expecting low-maintenance coastal living, the combination of falling values and rising costs has been jarring. Some owners who once imagined passing these homes down to family are now considering selling instead. Golf courses, clubhouses, and resort-style amenities still look impressive, but behind the scenes, more owners are quietly listing properties, hoping to exit before conditions worsen further or another major storm hits. If you once dreamed of retiring to Naples, this market offers a cautionary look at the total cost of owning in a hurricane-exposed luxury destination, where climate, insurance, and association rules all play a role in long-term affordability.
Number 1. Palm Springs, California. We end in Palm Springs, a desert city that became a global symbol of mid-century style and warm weather escape. During the pandemic surge, home values here climbed to astonishing levels, with median prices nearing $1.2 million in some reports by early 2022. By 2025, those same medians have fallen to the high 500,000s in many areas, a decline of more than 50%, and in some short-term rental zones, the drop has been even larger, wiping out years of paper gains. During the boom, buyers from Los Angeles and beyond snapped up older ranch homes and bungalows, renovating them into vacation rentals with stylish decor and premium nightly rates. For a brief period, it worked. Bookings were strong, and social media helped market the lifestyle. Then heat waves intensified, tourism patterns shifted, and local officials tightened short-term rental rules. New permit limits, stricter enforcement, and steeper fines changed the math for many owners who had counted on high occupancy to cover their costs and fund renovations. Some discovered that their permits could not be renewed under the new rules. Insurance has become another major pressure point. As wildfire risk in the region has increased, several major carriers have scaled back coverage in California or exited certain markets entirely. That has left many households facing higher premiums or limited options, often with policies that include larger deductibles and more exclusions. At the same time, energy costs in a desert climate where air conditioning is a necessity have continued to move upward. Water restrictions and fines for overuse add one more budget line in a place where lawns, fountains, and pools were once standard selling features. The result is a city that still photographs beautifully, but where the economics of ownership have changed sharply. Homes that once seemed like dependable stores of wealth are now harder to sell at past prices. Properties that were bought as rental vehicles now struggle to generate enough income to justify their carrying costs after utilities, maintenance, management, and taxes. Streets that once felt full during peak seasons now show more for sale signs and fewer fully booked driveways. Palm Springs shows what can happen when fashion, speculation, and environmental risk collide. It raises hard questions about how much buyers are willing to pay for a lifestyle that comes with rising costs and regulatory uncertainty. If you have watched this market shift, tell us whether you think it can reinvent itself yet again, or whether this correction marks a more permanent reset in how people value desert luxury.
Our journey comes to a close. From investor-driven turmoil in Cape Coral and Boise, to deep corrections in Las Vegas and Phoenix, to the luxury reversals in San Francisco, Naples, and Palm Springs, the pattern is clear. The 2025 housing downturn is not a gentle adjustment. In many of these cities, it is a full-scale reset, exposing how fragile some of the most celebrated markets really were. If you are thinking about buying in one of these places, you cannot rely on past price charts or sales slogans. You need to look at insurance, long-term climate risk, job stability, local policy changes, and whether the people who make a city function can still afford to live there. If you already own in one of these markets, you are living that reality every day. If this deep dive helped you see the bigger picture behind the headlines, please take a moment to like this video, share it with someone who is thinking about a big move, and subscribe to Discover the Nation so you do not miss our next investigation. Tell us in the comments which city surprised you the most and which market you want us to examine next. Thank you for watching, and make careful, informed decisions out there.